Investors buying the dip Monday afternoon, sending the S&P 500 up 2%. Is this a dead cat bounce? Well, let's ask Dan Suzuki. He's Deputy Chief Investment Officer at Richard Bernstein Advisors. Welcome back, Dan.
Thanks, Fred.
After the massive sell-off this week, we're getting a bounce, a rebound today. Everything's up across the board except energy and materials, but volume seems to be a little weaker. What you're seeing today, is this sustainable, or is this what we call sometimes a dead cat bounce?
Yeah, it's an interesting question. I think if you look at sort of how fast and furious the sell-off was last week, it's to be expected, or not to be. You shouldn't be surprised at sort of seeing this bounce. If you look at how oversold the market got. I'm not a technical analyst, but I think we don't really trade the day-to-day of these markets. But I do think that you're still getting some warning signals from the internals, and there's still some fundamental things to be concerned about. You look at the leadership today. It's been led by the defensives, so that is not sort of an all-out endorsement of the rally, in the overall market. And you look at treasuries as well. I mean, they're rallying as well. So I think that you're guiding the internals of the market is saying there's still some things to be concerned about. And then, by the way, we also got a huge round of fundamental data today. The PMIs came out. The global PMI hit a new low for a multi-year low as well in contractionary territory. So.
Well, Dan, the S&P 500 fell nearly 12% last week, and you had Goldman Sachs forecasting flat profit for 2020. In light of that, are the valuations justified?
No, I mean, that was our issue to begin with. I mean, coronavirus or no coronavirus, I wrote about this a few weeks ago. The market was getting pretty frothy. I mean, it's interesting. We were trading at, roughly 19 times on a PE basis. That's the highest level that you've seen since the tech bubble. Right, so and a lot of people that we talk to say, oh, well, it's okay because interest rates are so low. The piece that I wrote about talked about really three key questions that you should be asking yourself if you want to say that interest rates are justifying those valuations. The first thing is, if rates are discounting slower growth, does that warrant a higher multiple? In my view, probably not. Secondly, are rates going to stay low for a long period of time? Because if they're not, then that whole valuation argument is mute. And then lastly, and most importantly, what does the empirical data suggest? And the analysis that I did shows that incorporating low interest rates into the valuations actually makes valuation a worse predictor of future returns, not a better one. So all in all, I don't think that the lower interest rates really do justify higher valuations, especially if they're not going to last for the next 10 years.
And I read that this is dated February 18th, the day before it peaks, so pretty
That's
good
right.
timing on that.
I'm like Nostradamus, right?
So I should ask you a few more questions then.
Yeah.
The 10-year note that you were just bond that you were just talking about, it hit 1.08% today. So what does that tell you?
I think that tells you that there's still risk to the market. The bond markets and the stock markets are telling you different things. And I think the bond market has at least over the past few weeks been more correct in terms of the downside risks, and that's been our view. I think one of the things though is that what's happening is that people have been fleeing the stock market in fear of coronavirus, and they're flooding into what may be the most crowded, most expensive asset out there. So is this removing the excesses out there in the financial system, or is this actually making those risks, longer term risks worse? That's the question.
Good question. And lastly, are you reallocating any assets in light of what we saw last week?
We are not, and I mentioned this before, we're not event-driven traders, so we're not going to be shifting positions based on a couple percentage point move in the market. We've been sort of for the last year or so, toning down the risk profile of the portfolios, taking our foot off the accelerator pedal, and we've been, looking for more out of favor, defensive, higher quality assets in the portfolio to give you the diversification that you need in times like this. So, roughly of a flagship portfolio, roughly 30% is in gold, tips, in China. And those are very out of consensus, out of favor areas, and those have actually been holding up very well through the volatility in this year overall.
You mentioned China.
Yes, that's right. Yeah, China, interestingly, not so surprisingly, is very out of favor, very cheap. But what we've been seeing is, prior to coronavirus, the data was actually getting better, largely as a result of all the stimulus that they have been doing. Now, the good thing looking forward is that they're probably going to stimulate a lot more. They have been stimulating over the last few weeks, but they have plenty of ammo to continue doing that. So I think when I look at areas that have the fiscal space or the ability to continue to stimulate, China sticks out as one of those areas. And by the way, the market was very quick to price in the first order effects of coronavirus, and that's why China sort of went down so fast. But as you look, people weren't discounting the second order impacts of supply chains and the spread around the world. So what you've seen is that China has actually been one of the best performing countries this last month during the volatility, because it sort of got priced in early, and then actually now they're getting a little bit less bad, I think is a good way to describe it.
So investors might consider putting some more weight in
That's
China
right,
at this
yeah.
point. All right, thanks a lot, Dan.
Thanks, Fred.
Our thanks to Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors. I'm Fred Katayama, and this is Reuters.